Always one of my favorite segments. Jen McGuinness is with me, CEO of Pivot Financial, and we start with a little-known nugget. I said to Jen that I was not going to embarrass her or reveal her high school yearbook photo or anything like that, and she said it would actually be an interesting thing because little did I know, or probably did anyone know in the mortgage business, you went to a performing arts high school, and were you an opera singer?
I was. I was a classically trained opera singer. And actually, before I went to regular college, I also went to a music conservatory for operatic voice.
Oh, my goodness.
Yeah, it is true story.
Now, do you perform on Ask?
No, not anymore.
You
I've
still have
not taken a voice lesson in a long time. Before my grandmother died, I came out of retirement periodically for her. But no, I'm not a regular singer, although I occasionally get threatened by friends that I'm going to have to go to karaoke. And an opera singer at karaoke is quite an interesting thing.
Do you
We
think you
don't
still
do
have it?
pop music all that well.
Do you think you still have it?
Oh, I can still sing, Greg.
Okay.
You'd be pleasantly surprised.
You give Pavarotti a run for his money?
Nope, I am not a tenor. I am a very high soprano. So,
okay.
very
Then.
different voice than Pavarotti.
Oh, my goodness. We have so much to talk about.
Yeah, we're going to have to do that.
I know. So we're recording this on Friday, and this will air on Monday. Not too much is likely to happen in the next 72 hours in mortgage, although things are moving pretty quickly. And obviously, we're going to jump into this ongoing debate on single file credit versus bi-merge versus tri-merge with Vantage Score and all these other things. There have been a lot of developments. Bob Brooksmith, the president and CEO of the Mortgage Bankers Association, has really been doubling down on this idea of a single file credit report. And it seems to me like there has been a symphony. You like how I weave that in there?
I do.
Well done. Of detractors, despite the fact that Bob claims that this is something that the industry wants. Before I share some of Bob's comments this week, where do you stand right now at this hour on this issue?
I do not personally believe that a single bureau change is a good idea.
All right. Well, give us a little bit more than that.
A single bureau pull will not cover, in the large majority of cases, the full debt profile of a prospective borrower. And, I do not agree that at a certain FICO threshold that it will. Listen, there are, in certain instances, that, credit backgrounds will be covered by one bureau or not. When tested, that is not what the findings are across the board. I also think, the market needs to be careful about regulatory impacts that could come out of, treating different, credit classes differently in the underwriting process. And, the way it was initially proposed was move to a single bureau pull for 700 plus FICO borrowers. And we all know that, when different structures are employed for different types and segments of the market, there are regulatory constructs that go with that. I mean, the Federal Reserve, for example, noted that credit scoring models might produce a disparate impact at times. And if specific characteristics were to act as a proxy for protected demographics, this could possibly be triggered. For example, a correlation to lower credit score borrowers, if it equaled, call it underbanked or underserved communities, that would be an issue, right? And I don't think enough analysis has been done with enough of the market to be able to really make the statement that over 700, there's really not a big deal moving away from from tri-merge.
Well, Bob keeps referencing data from tri-merges, which it's not apples to apples. We can all see the delinquency rates, which again are arrived at through the tri-merge, right? It's very predictable. Everybody knows what you're going to get. The secondary market understands what kind of risk that they need to build in. You've got the LLPA factor. There's so much of this that we want to get into here. I want to first play the very latest from The Big Picture. This is a show that is hosted by Rich Swerbinsky, my friend, and Robbie Chrisman. This was just yesterday on Thursday. Let's hear what Bob had to say about this idea of a single pool?
Was really settled 3 years and 3 months ago by FHFA. And remember that FHFA is not just a regulator, it's a conservator. What are they conserving? They're conserving the assets of Fannie Mae and Freddie Mac. So when they came out with a decision 3 years and 3 months ago to say, we don't need a tri-merge, we've done the research, a bi-merge is just as predictive as a tri-merge, I'm not sure why we're still arguing about why we need a tri-merge. Now, I will acknowledge that there are implementation issues that are very important, and all of them were discussed at length during our policymaking process, and we have a lot of good ideas for how to do things like ensure that if a loan officer or whoever in various companies is responsible for pulling credit reports chooses to pull more than one, let's say if this policy went forward, that Fannie and Freddie, of course, are entitled to see whatever is pulled, because the last thing we want is for somebody to say, well, I'll just pull 3 and I'll submit the highest. That clearly would be a bad result.
All right, so let's stop right there. He's saying that that would be a bad result. I'm not sure if he understands what he's stepping into there, but he's clearly referencing that you can gamify and that it would be detrimental to just have that high score. So I think that says a lot right there.
And listen, I have loads of respect for Bob. Full disclosure, Pivot is an MBA member, etc. But he's also, intertwining 3 totally different topics in that feedback, right? It is true that the GSEs through FHFA agreed that a bi-merge may be a reasonable change for credit scoring models years ago, but they also did not make the change to their requirements to say, sure, send me a bi-merge. He's also, so there's that. Then there's lender choice brought up in there. And lender choice, the way it is structured today, is very clear if they ever get the other credit scoring models implemented. And there's a lot of good reasons why to or not do that. But lender choice is really clear. Only pick FICO or Vantage, and do not send me FICO and Vantage on the same loan. Pick one and stick with it, right? So Bob is saying, oh, well, if a loan officer ran another one, we'll make sure that disclosure is given to Fannie and Freddie. Actually, they're saying, don't. Just send me what you used, right? One or the other, again, if it ever happens. So I think that's important. Where he's talking about, single pull and having ideas of how to implement and whatnot, now he's talking about current. And my whole thing is, if he's got great ideas how to implement that, we haven't even gotten, both credit scores live with the GSEs to begin with. So now we're going to go to a single pull from one or the other. It doesn't make any sense. So what's the ideas? I think the idea right now, if the change is going to be made, is you got to go with what exists. And I do not foresee in a reasonable way, unless they are forced by, entities that are not them or FHFA, I do not see that it is reasonable for the government to say, sure, do a single pull solely based upon a very small subset of members on a ResBog panel at MBA. It's not reasonable. I did ask for the data behind that analysis, and I was told the lenders didn't provide it to MBA. And that concerns me more. They just took at face value, allegedly, the word of, I don't know how many members on that group actually participated. And, my whole thing is, what made them comfortable? What data did they see? What data did they analyze? And I personally asked for that, and I'm hoping that one day I'll be provided with it.
Well, do they have data? That's the question.
Well, that's the real question, right? I asked very specifically, do you have the information and the results of the alleged feedback from the ResBog members? And they said the lenders were not able to provide it to us, or the members were not able to provide it to us collectively. And therefore, no, we never received the information. They took feedback. We don't know one or more. We don't know if one person took, like, one entity, 20 entities. We don't know the answer. They took just feedback and ran with it. And, to me, that doesn't make much sense. They have some really great economists and really smart data guys there and girls. Like, why wasn't there, a more robust test for this?
So earlier in the week, the AEI housing market indicators, it's a monthly release by the Housing Center. It's called the Housing Market Indicators, and I'm going to share a chart with you that they released to the public regarding tri-merges and this idea of a single pool, and then we'll unpack it. Here we go.
The score distribution between the highest of the three bureaus minus the lowest of the three bureaus, and we plot that by percentiles. We're finding, yes, that at the lower credit spectrum range, the ranges are wider, but even at the higher end, there are still significant differences. And amongst borrowers with a decisioning score above 700, the high-low spread across the bureaus averages 26 points, and it reaches 61 points at the 95th percentile. So there's actually quite a bit of variation going on from the data that we have seen, which seems to be different from what the MBA has access to.
I mean, that's pretty damning, that last sentence there, that the MBA doesn't seem to have access to. This is a bipartisan nonprofit that does a lot of research for the industry. What do you make of that?
Yeah, I mean, I can't speak for what MBA does or does not have internally, right? I can only speak to when I ask a question, what their response is, right? And I asked them specifically about the data that was used from the committee and was told they were never provided with the data. What I would say is there's a lot of ways to run numbers, right? And I have not unpacked the entire write-up from the guys you were just showing on the screen yet. I will. I have, however, deep dove into the data ourselves and also looked at a vast array of other research-related documents as well. And quite frankly, I'll talk about my own tri-merge, okay? My own tri-merge, if you run it, has a huge discrepancy in it. Some show, credit that I paid off years ago as open. The other ones show, things that are only for my husband on my credit report. You see what I mean? So, just as a consumer, Jen the consumer, I can tell you my own credit report has a lot of dispersion. And then away from that, I could also tell you that I'm an over 700 plus FICO borrower, right? So just as me, myself and I. And then they're not wrong. There is a dispersion in the three different bureaus' data, no matter where you sit in the scoring bands today. And there is dispersions in general. Now, are you going to find guys that are going to have identical? Yeah, but mostly it's going to be in the non-complex credit, right? It's going to be people that have only had one mortgage or one credit card or three credit cards or, things like that are very straightforward.
Mm-hmm. I'm going to hit you with some just random stuff here. There was an idea that perhaps, I think Bob shared this, that, what about a system where there's no credit score at all? I don't really understand that. What's he alluding to there?
Yeah, in fairness to Bob, he wasn't really saying what if there was a system with no credit score at all. He was saying that data could be used possibly in supplementation to credit reports that in theory could show you how a borrower really is managing their, cash flow and debt. And, some of the things that have been proposed over the years have been, bank statement data and certain other things. But, that's not new. There are obviously loans that are originated using a bank statement underwrite, but those loans also still include credit reporting data, right? And credit scores.
Yeah. Bob refers also to the fact that lines of credit typically use one score, and they seem to be performing well right now. I think we all know that during the financial crisis, they were among the first loans to go bad. So, part of this is just using the moment to their advantage in terms of the narrative. But if you go back and look at the last time HELOCs were as popular as they are right now, in 2006, the delinquencies, 90 days or more, just 2%. And by 2009, 2010, they had reached 10%, and they peaked north of 15% at one time. Seconds defaulted 2 to 3 times the rate of first liens. So is it really apples to apples to say they use it and they seem to be performing well, as if to discount the fact that people's homes have doubled, sometimes tripled in most instances in the last handful of years, which is the data that they're looking at? Is that conflated?
First and foremost, not all HELOCs are underwritten with one single score. Many a HELOC is underwritten with a tri-merge, just like every other loan. And, so that's a very broad brush statement, but it's not 100% factual. So I think that's important, right? With regard to, housing crisis related performance data on second liens versus today, is a very different environment we're in today, Greg. A lot was very different about how properties were valuated from a valuation perspective historically. Lenders could call appraisers directly, tell them what the pricing of the properties would be. There's a lot of restriction that's been put on that. There's a lot of safeguards for properly underwritten, loans that are in the HELOC universe. But are there HELOC products and, quite frankly, first lien products that are not properly valuing properties today in the best way? Of course, right? Nobody can say that there's not. But I do not believe you would see the same type of delinquency and charge off today, barring, certain things occurring in the market to make it happen.
But isn't that the question? I mean, don't we have to always be prepared for the next crisis? Well, have we not learned from
it's
previous?
a little dystopian, right? The goal in this industry really should be to stop having selective amnesia, right? And I think even though the mortgage market in general is cyclical, and yes, you and I have been in this business long enough to live through many cycles, not most of which were the same as the housing crisis, but the housing crisis was also extended by virtue of, certain activity from, the government and other counterparties that elongated the correction that was taking place then, right? But, fast forward to 2026, you've got some guys out there doing low doc, no doc type loans again with extended LTVs, back end DTIs of 50 plus, et cetera. And, that doesn't mean that every lender should originate that product. So we do not need to be thinking about a housing crisis every time. I think markets in general change, react, and expand and contract. And that's going to happen in a cyclical way.
Yeah. I mean, you say that and I got it, but a very highly respected voice in the mortgage industry and housing, Chris Whalen, who I know feels kind of differently when it comes to what's around the corner. And that'll be the next thing that I share here is a previous conversation that I had with him. Let's hear what he has to say about values and what he believes is about to go down. Tell us how you arrived at that very unpopular thesis that we need house values to go down something more than 2 or 5%.
The president came right out and said he is not going to break housing. He's not going to force prices down and therefore cause people who bought a home in the last 5 years to lose money or end up underwater. We're already seeing the number of homes that are underwater in the FHA market, for example, rise pretty dramatically. Look, the Fed used low interest rates during COVID to fix an immediate problem. The Treasury market had stopped functioning. We dropped rates to zero and voila, we had a bull market in housing. We had half the mortgages in the country refinanced. I think you're going to see an uptick in activity this year and next. And then we have a housing price reset about what you're talking about, 15 to 20%, maybe a little more. Maybe we get down to 22 or 21 levels.
Yeah. So, I mean, you're saying don't prepare for the worst and don't live in the past and things are different today, but he's seen a lot of things. You're looking like you might be a little bit skeptical. And I know you respect Chris.
I'm not skeptical. I'm humored. So I love Chris. I've known him for 100 years. Him and I could spar for hours about the details of things. We're kind of geeks like that. What I would say is he's making a lot of real general comments there without no defined, way in which he believes that pricing will end up, going down from a valuation perspective, 15 to 20%. Right? He's talking about the president, then he's talking about, 3 different things on 4 different levels. Look, at the end of the day, if you do go and you take rates down to 0, right? And then you have every borrower with a 3-handle rate that's now could get a 2-handle rate loan putting their houses on the market because they've decided to move and go wherever it is they now want to be, right? You're going to have the valuation decline naturally just by virtue of oversupply on the market, okay? If you stay logical and rational with regard to rate adjustments, you're going to have more tempered supply, houses listed for sale, right? That's going to keep valuations in a reasonable way. Think about it. It's kind of like you throw too many houses that fit a borrower's wants and needs at them. They're going to find the one that makes the best sense for their dollar. And then the guys that own those 25 houses that are the exact same, right, are now going to all be in a bidding war to the bottom, quite frankly, for the would-be buyer to buy the house. That doesn't necessarily mean that the value of the house has declined. It's what someone's willing to pay for it. And if they have 25 different options, now you've got a buyer that's got negotiating power, not a seller, right? So I think you also have to look at the common sense factors of what impact valuation, right? Doesn't mean the valuation at origination was wrong. Doesn't mean the valuation wouldn't be upheld. Remember that an appraisal or any valuation product is an opinion based on comparable values and characteristics of markets. And we have licensed appraisers that take that apart and then make an opinion determination based on those details, controls, and requirements. But at the end of the day, if you have identical homes and you're showing them to two different borrowers, and when you walk into the exact same house, all of the walls are painted black and have gray carpets in one house, and in the other, it has more neutral color convention and whatnot, depending upon who that borrower is, one or more of those homes is going to be more palatable, and they are going to have an opinion of how much they would pay for each home, right? So you've got the buyer's opinion of what they're willing to pay. You've got the seller's opinion on what they believe the house is worth, generally backed up by a realtor's valuation information. So again, if all of a sudden you put the market into a buyer's market and you got 25 of the same house, buyer's going to be in a negotiating position to bring the value purchase price of the house down. That doesn't necessarily mean that the market itself on its own, without that fact pattern created, would all of a sudden decrease values 15 to 20%.
Well, in your mind, what's going to be the catalyst then? Because as I look at these stats in front of me right now, they're about 1.98 million sellers versus 1.35 million buyers in the U.S. right now, meaning sellers outnumber buyers by 47%. Yet many people will say we have a massive inventory problem. So there's obviously something more at play here. How do you unpack those stats and the argument that we're short 5 million properties, which some people will make?
Yeah, I mean, looking at that nationally is not the right way to look at it, Craig, right? You have to look at it in the actual markets, and you have to take it market by market, right? And you're going to see that there's a supply-demand imbalance as you go into certain markets. And then there are certain markets that are absolutely oversaturated with supply, and nobody wants to buy the houses. You know, the world in general in our industry has to remember that there are places, for example, that have always been rental markets, okay? They don't have high home buyer percentages. They have to remember that there are certain markets that have shifted to be, you know, more owner occupied than others. But there's also markets that are second home markets, right? Where people generally own those homes as vacation homes, right? So you have to really think about this stuff more into the weeds and the details than thinking about it from a national perspective.
Yeah, totally agree with that. Let's look at the other side of the coin now, right? Because we just talked about this idea, and I agree with Chris Whalen, not necessarily that we're going to have that big of a correction, but that the way to bring affordability into focus is dual. It's a combination. It's lower rates and it's lower home prices, right? Because that loosens it up on two ends. But then you have the president who had this to say just a couple of days ago.
Existing housing, people that own their homes, we're going to keep them wealthy. We're going to keep those prices up. We're not going to destroy the value of their homes so that somebody that didn't work very hard can buy a home. We're going to make it easier to buy. We're going to get interest rates down. But I want to protect the people that for the first time in their lives feel good about themselves. They feel like they've that they're wealthy people.
Yeah, I mean, I don't know about that. Like the people that own, we got a lot of people on the outside looking in that would like to be feeling like that right now. So like, I don't feel like that. You don't feel like that, I'm sure. So, I mean, is he representing the minority, the majority? And then what happens if he's able to make that happen and properties then all of a sudden reverse? Because right now we're flat to down. What if all of a sudden something happens, some kind of stimulus or impetus is in place where the prices go up 10, 15, 20 more %?
So I think you need to unpack President Trump's commentary. First and foremost, he said, we do not want people who own their homes, right, to lose money. They're feeling wealthy, they've got equity in their homes, etc. He did not say, we do not want to take homeowners who want to sell their homes and make them feel wealthy. That's first and foremost. Because on the inverse, he said that in order to have people buy more homes, I need to decrease interest rates. He did not say I need to make the valuations of homes cheaper, right? So I think that, again, you have to look at what people are saying and unpack it into component parts and then actually analyze what they're saying, right? If all of a sudden President Trump took action that decreased the value of the Americans' owned homes significantly, the midterm elections would be very special, in quotes, right? Special, right? What I'm saying at the end of the day is unpack the commentary.
Well, it looks like the midterms are going to be very special anyway. If the midterms,
We'll see, right? I mean, listen, like whether we like it or not, politics can shift quickly, right? And the manner in which constituents feel and the sentiment in different markets can shift rapidly, right? So I think there's a lot to watch for the midterms. And look, if all of a sudden things start to really shift Democratic, I think you will see different policies and things that are being discussed now handled very differently. It's the nature of the beast of, red and blue, right? They go about things differently.
All right. So from your experience, how big is the window for this administration as it stands right now to do something substantive? Like you look at what the president said, I believe in his last State of the Union, one of his big speeches, he said, come the new year, come 2026, sweeping changes for housing. Well, we haven't really seen that. Like the best idea we've seen so far has been this highly debated idea of tapping into your 401k, which again, it's like the 50-year mortgage, the assumable mortgage. We haven't really heard anything about that since Davos. We expected him to have a long list of changes. None of that has happened yet. So two-part question for you, like how big is that window? And do you expect that something will happen before that window closes?
Yeah, so I'm going to beat my drum again on this, and then I'll answer your window question. Do the detailed work to know what will actually move the needle for the market. Nobody's doing the detailed work. And then don't have one thing that could help a component of a market ruin the life of other people, right? I mean, in the long run. So if all of a sudden somebody can take $300,000 out of their 401k and they only have $320,000, and that's not what they proposed, but I'm giving an egregious example on purpose, right? They only have $320,000 and they're 55 years old. Is that a good idea if they want to be able to retire in the next 10 years?
Terrible.
So again, broad brush does not work. With regard to making and effectuating a change that people will believe is really a change for the midterms, the effectuating of that change has to happen now and in the next, in my opinion, 30 to 45 days max.
Any ideas that are out there now that you think could be driven home by then, or anything that you've concocted?
I'd say that my concern is that, they're going to look to make headlines and not do the up and downstream impact work of what those headlines or ideas could be. But I think the market has to think about them as, are they just headlines or are they really going to happen right now, right? How long ago, Greg, was we're going to let Vantage actually be accepted by the GSE's announcement?
That's about eight months ago.
Okay, well, where are we on that right now?
We're nowhere on it.
Right. So my point is, are we making headlines or are we making reality changes?
Well, and where is Vantage Point? Let's keep it moving. Like, to me, it doesn't seem like this is going anywhere.
But I don't necessarily think that's a bad thing either. right? The model for the Vantage score is very, very different than the FICO score. Also, comparing Vantage 4 to FICO Classic makes absolutely no sense when FICO has a newer model, the FICO 10T. And quite frankly, that was the model that was tested side by side to Vantage back in 2022, right? Actually, it was 2021 into 2022, not FICO Classic. And really, you know, the voiceover from Vantage is, oh, we perform so much better than FICO Classic. I mean, not to be blunt, but who cares?
Well, let's
Right?
go back to what you just said, that it's not prudent to improve one class of the market and not do something for the other. I'm paraphrasing, obviously, but in a single pool world, getting back to that, what does that do for the first-time home buyer?
Well, I mean, the question is, how is the single pull determined, right? You know, I've spoken about this before. If you were to implement a single pull, who's making the decision as to which bureau is being pulled? Is it the borrower or is it the lender? Right? If all of
But
a sudden,
what decision is there to make? You're going to take the highest score. What kind of decision is there to
well,
make?
no,
Right?
technically a single pull, you should be making an upfront decision to only pull one score, not pull all three and pick the highest.
Yeah, I mean, you want to talk about a catastrophe. There you go. Welcome to a
Right.
catastrophe.
So
right
what I'm saying is, technically, if you do a single pull, you should only pick one, right? Experian, TransUnion, etc. Right? So now you pick. Let's say a borrower picks Experian, right? The lender picks Experian, but let's say the borrower would have qualified for the loan if they pulled TransUnion and not Experian. You don't think that lenders are opening themselves to undue risk if a borrower finds out that they would have qualified if you pulled a different score?
Well, I don't know. I mean, I went and did a little experiment the other day. I went to freecreditreport.com, and for less than $30, I got all three of my scores.
Yes, you
And
can do that.
hey, $30, $30.
Actually, most banks will give that data to you for free.
All right. Well, I spent $30 and I got all three of my scores, and I can call any lender I want and say, hey, these two don't look so good, but my Equifax looks stellar because I'm late on a car payment, which doesn't show up on here. Take this 740 and run.
Yes, in theory, a borrower, if they knew how to do that, Greg, could do that, right? Most borrowers don't know how to do that and analyze their credit report. They do generally know what payments they are or are not making. But I think that, you know, we've got a broader question here. If all of a sudden, whether it was the lender making the choice or the borrower making the choice with regard to single pull, if it was the borrower making the choice, it would be a little bit harder to, you know, argue something like disparate impact because they'd be making the choice themselves. But let's say it's the lender making the choice to only use Experian, in my example, right? Do we now have a redlining problem, right? To the correlation of the scores. Let's say we implemented what MBA is talking about, only a single pull in excess of 700. Okay, well, where does the majority of the below 700 FICOs live? Has anybody done enough work on that to know if it is only sitting in certain markets or demographics or whatnot? I mean, I've done a lot of work on that. Not enough data is available to be able to guarantee where it is, but you will see a larger subset in more diverse areas, right? So now do we have an issue where credit scoring and, you know, giving a differentiated type of underwriting to a 700 plus FICO triggers other regulatory concerns? And I don't hear anybody talking about that.
No, I mean, there's so many layers to this. I thought of one earlier today. You ready for this one? Think about it, how a single pool will impact Ginny and FHA loans. What this is going to do is it's going to suck up those in the cream of the crop of FHA, right? It's going to suck up the 670 to 700, which is the high end, I'm sure, of their loan quality. Now that's going to end up moving upwards towards the single pool idea. And so FHA is going to end up eating a shit sandwich.
Maybe, maybe not. It all depends on how much of a down payment the borrower has, right? You know,
we're talking about an FHA, right? I understand, right? But you can still get a conventional loan with very little down. So I get what you're saying.
But all I'm saying is it really depends on what the borrower's structure and their details can actually qualify for. I think it's a maybe, right? But you know, it hasn't happened yet. But I'll tell you, we're doing a ton of work to understand it, and everybody on the street that, you know, looks at loans, buys loans, a bond buyer, you know, anybody who's securitized loans should be doing a ton of work on it. But then the question is going to be, is it a waste of time? And it never gets implemented. You know, we don't know the answer. Neither do you. Neither does anybody else at this point.
All right. So you have years and years of experience in every facet of mortgage. You are a true unicorn in this industry. And among the hats that you wear very well is an understanding of bond buying, the secondary market, MBSs. I mean, you've had your fingerprints on all facets of the secondary market. So I have to ask you, well, how will they, let's say this goes through. Is there any scenario in a single pool world where there's not an adjustment to risk, to unknown risk that comes from the bond buyers?
No.
Okay. And how great could that be?
It depends on who the bond buyer is. I think that trading in general is generally segmented into multiple categories as to the type of trader that is going to be, or portfolio manager that's making the asset selection for, whether it's a bank, a fund, a REIT, whatever. And, there are fundamental guys that really do the work. They really dig in and they analyze, et cetera. And then they come up with, what their positive and negative adjustments are going to be, whether it's when they're buying whole loans or securitizing or buying bonds, right? Then there are, what I lovingly call this pie in the sky people. And the pie in the sky people really make educated guesses and then make corrections based on educated guesses and watch and see what the rest of the market is doing. And then add a, this is how I feel about it factor to it. So I think that, it's going to depend on the who. But at the end of the day, if you all of a sudden swap out FICO and go to a single pull, put a Vantage score in the middle of a bond, right? Without, significant amount of research and, credit risk assessment and whatnot being done, those bonds are going to get hit, and they're going to get hit significantly.
Yeah. I mean, you're talking about saving a couple $100 for credit in exchange for something much more.
Losing in the overall structure of the liquidity market, thousands upon thousands, if not tens or hundreds of thousands. Well,
and we haven't even talked about LLPAs because right now, if I go to price a loan for you, and you have a beautiful 760 score, but then your middle score is 711. Right, I'm using the middle score, and what are the agencies getting for that? Another 125, 150, 175. I don't know what the exact number is, but that's real money on a $400,000 to $500,000 loan, right? You're talking about tens of, I don't know if it's billions. I don't know how big the number is. Maybe you do, but now you just take the 760. So what this is going to do is it's also going to end up sucking revenues from the GSEs, and you could say, well, they were never supposed to make money anyway, but that ship has sailed. They are operating as for-profit entities now.
But let's say that 760 all of a sudden becomes that 690, 700 FICO borrower. You don't think that the GSEs are going to watch what that risk change is and adjust the LLPAs accordingly?
Well, that's what I'm saying. That's my point.
They absolutely will.
We just talked about the bonds. Now we've pivoted over to the LLPAs. The problem with the single pool, everybody, the problem with,
right. I mean, if when you deliver bonds and bonds are issued, whether it's agency or non-agency, right, there's a risk of an unknown in there. And let's just talk about the GSEs for a minute. They're going to make less money than they're making now by billions of dollars, right? Billions.
That's my point.
Right. And seeing as everybody's now turned them into for-profit entities instead of what they were originally intended, they're going to want the money back, right? And they're going to get it from somewhere. And it's just going to be, adjusting the grid to account for the risk of the change from the, credit category.
Well, and you mentioned earlier, we have a habit of having amnesia here. Let's not forget that not only were the GSEs not supposed to be these huge for-profit cash cows, but also LLPAs and G fees were supposed to be temporary once we got through the great financial crisis. So all of a sudden now, what we need to be mindful of is once we make this change, once we go single pool and all these other entities make their adjustments, the back end gets ready for the added risk, LLPAs go up because the government's not making their fair share. How do you think it's going to look when we realize we made a mistake and we try and get that money back? How much more expensive is it going to be to own a home then?
Depends on what the trickle-down impact is going to be and how much bigger the delinquency percentages are going to be. Because delinquent is going to equal, do you now have an increase in losses and everything else, which are the fundamental components how things are modeled, right? So I think that's a question, right? And I mean, that's why, again, beating my usual drum, Do the work, people. Don't just live in your little segmented world of wherever you live. Understand what the things that you are asking for are going to impact before where you live in the process and all the way after you.
Heard another idea that was in that same report by AEI. One way to solve affordability and that problem would be prepayment penalties, 2, 3,
Yeah.
4-year prepayment penalties. I know some of that exists right now in the non-QM space, which is still, I think, around 10%. So 1 of every 10 loans, whatever the real number is that something you'd be in favor of? Is that a possible solution to make housing more affordable?
I mean, protection on weighted average life of assets from a duration perspective can only do so much, right? Even if you have prepayment penalty protection, right? If you have an increase in defaults, it's going to impact your weighted average life as well, right? I mean, Ackman, has a lot of, the stock and the GSEs came out and, said, hey, why don't we, throw together some, 10-year prepayment penalties and things like that. You also have to remember that borrowers have to be able to live, right? We have to, be able to let them live. What happens if you work for a large corporation that's in multiple states? You're offered, a promotion, and now you need to move out of state, and you have a 10-year prepay penalty. That doesn't make sense. The market moved to more of a 2-year prepay. I do think that there are reasonable levels of prepay. I think a 36-month prepay makes sense. They exist in certain products today. One of them is first lien HELOC, but it's generally with regard to a percentage of the pay down of the balance on the HELOC very quickly. But, prepayment penalties do make sense in certain instances, but not in a 10-year type of way.
Well, I'm going to ask you a politically charged question, politically in terms of the MBA. Like, I'm a member as well. You said that you were, and certainly I value the MBA. I mean, I say that sincerely. They're doing very, very tough work. It doesn't mean we always have to agree with them. Clearly in this instance, you don't agree. I don't agree, right? Why do you think that Bob is dug in so hard on this when so many people have pushed back, including other trade associations? What is your answer to that question?
So I'm going to approach it holistically, right? I want to be careful about it only being Bob. But, the MBA is an organization. He is the head of the MBA. But it's not just about, what does Bob feel like he should be doing today? Does that make sense? I want to be real careful about that.
That's very fair. And thank you for that.
Right. So I think that's first and foremost. What I would say is that the MBA, here's the thing. You have people in the market that are just complaining about the fact that they disagree. And then you have people in the market that are having active conversations and sending information, data, feedback, etc., to the MBA and to others that have called for, these changes and other changes. And the one thing that I will say to the MBA is they are open to debate. They are open to those discussions. And, look, I think that you can make the most informed decisions when you include the broadest set of market stakeholders as possible, right? I do think that Bob and the MBA are looking to have a win. They've been working on this for a very long time, right? First attempting to work with the bureaus and then certain other things. So, so I wouldn't say that, Bob is dialed in on this and, maybe in a bad way. I think, any organization, be it the MBA, the CDIA, any of them, right, is as good as what they're discussing, as good as what they're seeing, as good as what their members are willing to work with. And quite frankly, those members that are willing to sign up for, many different committees and, dedicate their time. And I think that, that has to be considered here too.
That's fair. And you're extremely diplomatic. I must
say. Look,
say.
I'm not looking to be diplomatic. I mean, it's just realistic, right?
No, it's true. No, it's true. And the MBA will say, well, you could have sat in that room. You could have, had a voice here, but there are 46 people on ResBog. There are hundreds of thousands of people in mortgage. And we've heard from thousands of people. So maybe the
right, but at MBA, MBA, even though the discussion was at ResBog, this is still an ongoing discussion at MBA. I sit on the risk committee, for example, and on a couple of other committees, and they are still having active conversations about this. They are still bringing parties that are doing a significant amount of research in this vein, to those committees and asking for people to attend those committees as well. So this isn't only a, hey, I wrote a paper or a blog and doing XYZ, right? They are looking to, in their opinion, effectuate a positive change. But again, just looking at credit data from a certain segment of lenders on its own without considering the rest of what, the market will do is not the right way to come to a finite conclusion. And look, is there a way to do this where maybe you could get it done without causing problems like this? Yes, but that takes a lot of collaborative conversations and a lot less mudslinging, right? And the NBA is not the only one slinging mud, right? Everybody.
No, it's moving. Yeah, it's moving in both directions. Final question here, because I know you got a hard stop coming up. And this has to be a longer answer than 10 seconds. Deal?
All right.
Tomorrow, it's happening. Single file pull, or in the next 3 months. FHFA says chance to win. NBA says chance to win. The data that they have is the data that they go with. What will happen? What is your best estimation of what would unfold in the next year, 3 years, 5 years?
My opinion of what would happen immediately is every investor on Wall Street would still require a tri-merge until such time that they could assess what the impact is going to be, at least for a defined period of time. Because the investors that are not looking into all the details of the possibilities here right now would want to be able to do that work. And that would be a reactive, not a proactive approach.
That was about 16 seconds.
What else would you like me to broaden on that?
Well, no, I want you to broaden, but I want you to broaden by saying, okay, they see it, they know you've already said there'll be more risk. You've said that, right? We've agreed that there'd be more risk, that there'd be more premium built in for the downside. So what links?
So
how long would it take for this to materialize in a way that would impact housing?
So I'm going to bring this back to you, though, for a minute, Craig, and then I'll answer that question definitively, in my opinion, right? NFM is a lender, right? If all of a sudden the single bureau pull was enacted tomorrow from anybody, right? Not just, and right now, if it happened tomorrow, it's a single pull with a FICO score, right? Vantage is not ready, right? As you know.
Yeah.
Okay. Is NFM all of a sudden going to be okay with their possible putback and repurchase risk being on one pull? And don't you think your lawyers would want to take apart if there's any, regulatory risk that you could be taking if you make the decision for the borrower?
I'll answer that question. I mean, Bob Brooksman said that he's told FHFA that they will not support this unless lenders are indemnified by whatever the other two have, whatever kind of material impact they would have on a potential default down the road. And so
with regard to standing on it for repurchase, but that would not limit them from running the other two bureaus in order to, for example, sample select loans for review to identify other types of issues that could lead to buybacks or other types of risk that may not be in line with other underwriting guidelines, for example. Right? And just because, Fannie and Freddie may say we won't pull it, right, doesn't necessarily mean that the bond buyers are going to say, okay, that's cool. Right? Doesn't mean that the rating agencies still won't require the data when they're modeling deals.
All right, last question. I know I said that 4 questions ago, and I promise this is really the last question. Bob Brooksman calls you today. Says, all right, Jen, you made a lot of sense. You seem extremely reasonable. I know you well. I respect you. You understand every link in this chain. What do you think I should do?
The answer would be actually dissect the models in detail, right? Then actually do forecasts based on the changes for each of them, right? Understand what the trickle-down impacts would be. Bring the loan buyers and the bond investors into the conversation, and lenders, which we already have some of them, but not all of them, and have a conversation. What is it going to take for everybody to rely on this information? And what are we comfortable with today, 3 years from now, 5 years from now, 10 years from now? And what do we need to accomplish to make that happen?
You, my friend, are a housing gem.
I tried, Greg.
Will you sing for me?
No, not today. Maybe another day.
Enjoy the rest of your week. Thank you, Jen McGuinness, CEO of Pivot Financial.
You're welcome, Greg. Have a great weekend. And
All right. We'll see you
we'll
soon.
see this
Bye-bye
on
now.
Monday. See
Take
ya.
care.